Here's how you use this in practice. On your lower time frame, you look for the actual trading setup. This means identifying the order block, checking that it's a high-quality zone, and waiting for your confirmation signal. On your higher time frame, you analyze the overall market structure. Is the market trending up, trending down, or consolidating? If the higher time frame direction is aligned with your setup on the lower time frame, that's when you have a valid trade. You take the entry on your trading time frame, but your confidence comes from knowing the higher time frame agrees with your idea. Alright, now let me walk you through a trade example so you can see exactly how this strategy works in real market conditions. Here we're looking at the Euro-US dollar 1 hour chart. First, notice how the market is trending upward, creating higher highs and higher lows. This tells us buyers are in control. Then we spot a bullish order block. It's the last bearish candle before a strong bullish move created an imbalance. So we mark this candle as our order block zone. Next, price pulls back into this order block. Inside the zone, we get a bullish pin bar candlestick, which acts as our confirmation signal that buyers are stepping back in. Now, before entering, we check the higher time frame. Since we're on the 1 hour chart, our higher time frame is the daily chart. On the daily, we can clearly see the market is also trending upward, perfectly aligned with our 1 hour setup. With that confirmation, we go back to the 1 hour chart and set up the trade. Entry: inside the order block zone to achieve a favorable reward to risk ratio. Stop loss just below the wick of the order block. Target set for a 2-to-1 reward to risk ratio. From here, it's just a matter of letting the trade play out. Price respects the order block, pushes higher, and eventually hits our target, giving us a clean 2-to-1 trade. This is a textbook example of how powerful order blocks can be when combined with market structure and multi-time frame analysis. Now, let's flip things around and look at a bearish scenario. This is the US dollar, Canadian dollar on the hourly chart. As you can see, the market is trending lower, forming a series of lower lows and lower highs. Here, we've identified a clear order block. Now let me ask you a question. Why do we call this an order block and not just a supply zone? The answer is simple. An order block creates an imbalance in price. In this case, you can clearly see a fair value gap left behind. When this happens, the market is very likely to retrace, fill in that imbalance, and then reject the order block. That rejection is where we look for our entry. So after spotting the order block, we don't jump in right away. We wait for the pullback. Look at what happens next. Price pulls back, taps into the order block, and then rejects it strongly. This gives us a clean entry opportunity to short the market. But before pulling the trigger, we need to confirm whether this setup aligns with the higher time frame bias. Let's move up to the daily chart. On the daily time frame, the market is ranging. Notice how it was recently rejected from a resistance level, creating what we call a liquidity sweep.